Hello and welcome to the MoneyMagpie podcast. I'm Jasmine Birtles and I'm the founder of MoneyMagpie. And I'm joined today by David Ryder, who's a seasoned investor and the author of a new book called How to Invest Without Being Ripped Off. And it has a subtitle of Set Up Your Investments, Save Money, Get On With Your Life, which I have to say is my idea of investing. Set it up, get it going, forget about it, get on with your life. And this book, frankly, does what it says on the tin. It's helping readers to invest without being ripped off by extortionate fees. David, thank you for joining me.
Thank you for having me on the podcast. I appreciate it.
We'll talk about your book and what it tells people in a moment. But first of all, can you give us an idea of your background and your investing habits? You know, what brought you to the point of writing this pretty in-depth book, I would say?
In-depth but easy to follow is something you and I have spoken about in the past, that avoiding the rip-off fees and getting half-decent performance is actually a lot easier than many people realize, but it's hidden by people in the industry. But to your question, I've been working one way or another in the finance sector since 1995, and that's included launching various financial magazines and publications, and for the past 12 years being an investment writer, working for 4 of the biggest banks and investment companies in the country. Now, an investment writer is somebody who writes the performance reports, the fact sheets, the outlook documents, and the annual reviews for a bank or an investment company. I can't name those companies because what I say about them in the book, I don't name them in the book either, but what I say about them in the book is not very complimentary. But your listeners and readers and viewers will definitely be familiar with some, if not all of them. But it was working as an investment writer over these years that led me to write the book. To be completely honest, I couldn't continue making presentations and documents that were largely just excuses for the rip-off fees and awful returns. And a quick anecdote here is I've spoken to loads of people I work with and have worked with. None of us put money into the investments of the companies that we worked for. No
Wow,
one.
that says a lot.
And you'll see that 1 or 2 chief investment officers or chief executive officers will put money into the funds, but it's only so that they can say, oh, yes, we put our money where our wealth is.
Yeah.
But if you then ask them, oh, really, how much of your wealth is in it? Oh, well, that's really private, because it's going to be about 2%.
Yeah.
Because the returns are terrible and the fees are too high. But in terms of my investment habits, I've used my direct experience and the investment qualifications that I studied for to take over my own pension. And then I started off doing it the hard way by selecting individual companies to invest in. To be fair, that did massively improve my returns and slashed the costs I was paying. But I was doing it in a way that's very time consuming, and I had to pay for and analyze huge amounts of research and data and keep a close eye on my investments. And I was spending about £2,000 or £3,000 a year on research and analysis.
Wow.
Yeah, but it was the cost of doing business, and it paid off for me. I made really good money over 10 years on my investments. But I got sick of it because you're constantly watching your investments, and you know there are better things to do with life.
Yeah.
So I thought, okay, why don't I just copy the research of the big investment companies and banks, but use much, much cheaper funds instead. And my book, can I wave a copy around?
Yes, do, feel free.
So, yep, there we go. That's it. That's what it looks like. That's just an entire step-by-step, as if you're sitting next to me, as to how I do absolutely everything with all the funds I like, the platforms I like, and every step of the way of setting up my investments. So that's what the book is.
So you actually did your own, you picked your own funds. Does that take a lot of time now? I mean, because it sounded like, it took you a lot of time and effort and money. So have you found a quicker and cheaper way of doing it now?
Well, it's a really time-consuming process to do this, because if you look at the list, I've got tables of 110 funds. Yeah, so here we go. That's a picture of one of the portfolios that I've set up by copying the lower risk, medium risk, and higher risk portfolios of over 80 portfolios that all the banks and investment companies you've heard of have set up. And I've worked out the average for all the low risk ones, average for all the medium, and average for all the higher risk ones. And then I've gone through 4,000 funds and picked out 110 funds that are much lower cost. They're in the book. Every detail you need is there for you to find the ones you want, to do a risk assessment for yourself to see what level of risk might be right for you, and then to see how I set up my funds according to what's risk appropriate for me, what's the right amount of money I have to invest, and which funds I need for that particular portfolio. It's all laid out. So yeah, if you do it yourself, well, it took me 11 months and I know what I'm doing, but it's all done.
Good. That's quite something. And I know, I mean, a big section of this book is that we lose money on investments through fees, because it's one thing, as you say, to pick the good funds, but if you're being charged fees, you're going to lose, well, you could lose all the profit potentially, can't you? I mean, these, what are these various fees?
Well, there's a whole bunch of fees. I would go back a stage though and say that the rip-off is actually twofold. It's not just the fees, it's also the performance. And I have a cartoon in the book. There's a brilliant cartoonist called Peter Dredge. He's absolutely superb. So I got him to do some cartoons, and one of them is you've got a board meeting with the fees going up and the performance going down. And that is the reality. The more you pay in fees, from what I've found, generally speaking, the less the performance is, the worse the performance is that you'll get. So I've actually got some questions that we could come back to from your readers. And one of them is, what are the different types of fees? So I can address them more specifically there.
Yeah,
but
good idea.
To look at it this way, an active fund, they're the worst culprits. So an active fund is one in which managers do the research and analysis with the ambition or the design, i.e. false hope, of delivering a higher return than you'd get from the market, or what I would refer to as a cheaper passive fund. So an active fund is one in which you've got various, usually privately educated white men, doing loads of, and they're very intelligent people.
Very clever.
Yeah, doing loads of really impressive research and analysis to find, okay, what's likely to happen over the next however long, 1 to 5 to 10 years, and how should we position our funds for that? But then they charge huge fees for doing that. Why not just copy what they're doing, but with passive funds? So they've done all the research, thanks, and you then don't pay anywhere near as much because you have passive funds. Now, what a passive fund is, it's automatically run by a computer, and it just follows the performance of, say, the FTSE 100, which is an index of the biggest 100 companies in the UK. So if they on average go up, then the fund will probably go up as well. It won't match it exactly, but it'll copy pretty similarly. So to give you a comparison, an active fund on average, according to the Financial Conduct Authority, charges 0.89%. That doesn't sound like much. It is, because the average passive fund charges 0.15%. So 0.89 versus 0.15. If your fund value is going down, you're getting it eaten into even more because it's an active fund. And they will say, oh, well, the whole market's going down. So you've got the average of a passive fund, which will go down 0.15% because of their costs, 0.89 if it's active. The portfolios I've set up and show how I do it, they are between 0.05 and 0.08% a year. So if you can find an active fund that only charges 0.89% as a retail investor, very well done. You probably can't. It's more likely to be between 1 and 1.2%. But I'm going to be fair with the stats. The FCA, the Financial Conduct Authority, says the average is 0.89%. Fine. Mine are 90% cheaper, and I copy their allocation.
It is amazing though, isn't it? Because as you say, there are really clever people going into the
Yeah.
city. It's quite sad. I genuinely, as an entrepreneur, I would like them to be entrepreneurs. I'd like them to be going somewhere useful. But what most of them are doing, they're coming out of, Yale, Harvard, Cambridge, Oxford, LSE, whatever, going straight into the city, moving numbers around, and clearly not actually doing anything very useful. It's apart from the fact they're making squillions. It's quite a waste of their intelligence, I would have thought.
Well, if you're 21 and you're faced with the option of earning a six-figure salary off the bat, working very hard and under a good deal of pressure.
Yeah.
Not all of them, because quite a few of them don't do an awful lot. I know, because I've worked with them. I never got paid squillions, sadly. But I got paid a lot more than the national average. Mine was below six figures, but the average, according to Glassdoor, the average total pay package, I'm going to refer to my notes here, the average total pay package, yeah, for an investment professional in the UK per year is £216,591 as at August 2023. Now, not everyone working in a bank or investment company is going to be paid that. So if you know people who are working in banks or investment companies, be nice to them, because they're probably not earning those sorts of numbers. But all the really clever people and the people at the top, they are earning vast amounts of money. And yet the industry on average still makes a 21% gross profit margin after all those bonuses and salaries have been paid out. So the money that is being milked is enormous. Where does that money come from? The fees that you and I pay.
Us, basically. So we are funding their lifestyle and not getting anything back, really.
Well, we're being ripped off. And I've kind of avoided your question, which is that, you've got all these really talented people who are going into the best paying opportunity, and who can blame them?
Yeah.
You're 21, you've got a bit of student debt, you see somebody waving a six-figure salary at you, you're going to take it.
Yeah, makes sense. But as you say, it's from us. The money is coming from us. So I'm just thinking about these fees. So how much, I'm going to throw you something, sorry about this, but can you come up with a sort of vague idea of how much could the average investor be losing over about, say, 20 years if they keep paying these fees?
Yeah, well, if you understand compounding, which I explain in the book, and you were one of the first people to hammer that into my mind years ago. But compounding means that if you have £1,000 and you make 10% interest, then you've got another £100 on it, which means the next year you make 10% on £1,100. So, I mean, you know this because you taught me, but this is really important. Compounding is so important. It's ascribed to Einstein that he said it's the greatest thing. I don't think he did say that, but it's the sort of thing he would have said.
Eighth wonder of the world.
That it's one of the greatest things, compounding. Yeah. So there's over 20 years, the difference is massive. It's really difficult to put a number on it. But just imagine if your fund makes 1%, but you're actually paying a 2% fee, and that's compounded, your fund is doing this. You're losing value all the time. Whereas if it's a passive fund and you're making a bit more, then it's compounding and it's going up. And I've got a graph in the book that demonstrates exactly. There we go. That's what it looks like. So the big thick black line.
Oh yeah.
Can you see that? Okay,
yeah.
The big thick black line is what you're likely to earn from a bad passive fund. The dotted line above that is a 1 in 3,333 chance active fund that has done well over 10 years. You're not going to find it. The numbers are there. The numbers are there, and I go through it. If you can find that 1 in 3,333 active fund that will in the future outperform a passive fund, great. You'll make maybe over 10 years, you'll double your money, maybe. But with the passive fund comparison, you'll make maybe 80% on top of it. In a much more likely active fund scenario, you'll underperform the market. And then you've got the fees, which are worse as well. So that's before you hit really horrendous fees. So there's an example in my book of one particular company it's a FTSE 100 company. It's well known. It looks really posh, really impressive, and they are, in my opinion, cowboys. They charge up to 5% upfront just for you giving them your money. Now, if that doesn't scare you, it should, because immediately you've wiped out the first X number of years of returns you could have made. And then they're going to charge you fees every year. They might even charge you another form of extortion, which is performance fees. And then you've got the legitimate fees, which are the transaction fees, which aren't too much. The stamp duty you might have to pay as part of your ongoing charges figure, which is what every fund charges. It's the OCF. And that's what I talk about with the 0.15% for a passive fund, 0.89%, more like 1% or 1.2% for an active fund, and 0.05 to 0.08% for the portfolios I've set up and that people can copy if they want to. So, you know, straight away, you're just being absolutely hammered by active funds. And I can't put a number on it, but it can destroy your pension.
That's horrendous. It is extraordinary, really, how much we're being fleeced at the moment.
Yeah.
So let's go through the main points of your plan for reducing costs and improving your potential returns, because you've got a step-by-step plan, really, in the book, haven't you, about how to do this?
I have. Yeah. So that's why it took me so long to write the book, because I had to break it down for normal human beings. And the industry refers to them as unsophisticated investors. Now, there is some truth in that, because why on earth would you want to study all this stuff? You know, if you're a normal human being, you've got better things to do with your life. So that's why I've spelt it all out. Now, there's a free ebook which goes through 14 steps of how you're being ripped off, how they're doing it, blah, blah, blah. And that's free for MoneyMagpie readers, which we could come back to that later on. But the full book, there's sort of basic principles. And those are, number one, check what level of risk is right for you. So I've got a risk assessment questionnaire on my website, free to use. Everything on the website is free to use. And it's based on a really good University of Missouri risk assessment questionnaire. So I've copied that. I've given the link to what their original version is, and I've changed it from dollars to pounds, and from vacation to holiday, and all that nice stuff that some people really care about. But it's a lot more comprehensive than any risk assessment questionnaire I've seen on any bank or investment website. Now, there may be much better ones that I've not seen. And if you ever talk to an independent mind financial advisor, they will be much more thorough. But what the ones on the banks and investment companies tend to do is just push you towards low risk, because that way everyone's happy. No one realizes if it's right or wrong, and you're not taking too much risk. The trouble with that is risk is actually a good thing. You can't avoid risk. It's like fire. If it's out of control, it's terrible. But if you don't have enough, you go cold. You know, you can't cook without it. So it's a case of having it under control. And this is where the right risk assessment questionnaire is good. And I really like the University of Missouri one. So I've adapted that. Once you've got that, then you can get an idea of if the right level of risk for you is lower, medium, or higher. And once you've got that, then you can move on to the next step. And it's all there. It's a case of copying the investment decisions of the big banks and investment companies. Now, you could, if you wanted to, or your readers could, if they wanted to, go to any of the big companies and look for a risk-rated investment portfolio. And those will be lower, medium, or higher, but they'll have stupid names for them like defensive or dynamic or adventurous or cautious. What it boils down to is low, medium, or high. And so I've copied over 80 of those, and I've distilled it down to one massive portfolio. If you have, say, £500,000 that is lower risk rated, another that's medium risk rated, and another that's higher risk rated, then I've created simplified versions for that for everybody who has much less money, all the way down to, I think it's £1,000. So again, it's all done for you. You know, that's all sorted. I've copied their investment decisions, and that's stage 2. The next point is to choose low cost passive funds. So again, these are the ones that are automatic, that you don't have people doing loads of research. You don't need to. They're copying, say, for example, if the big bank's medium risk investment fund allocates 50% to UK shares, then instead of you allocating 50% of your money to an expensive active fund, I've got the funds you can use by name and number, so you can search and find them on a good platform. And I show you exactly how to do that and how to put 50%, if that's the right amount for you, into that allocation of a much cheaper passive fund. So
really,
instead of paying a 0.9%, you're paying for the fund I've just quoted is probably around 0.05 to 0.06% a year in your ongoing charges figure.
so you give all the step-by-step instructions for this in your book. So anybody who wants to do so, they can basically copy you.
Yes, absolutely.
Yeah.
I can't give advice by law, so I can't say you should do this, but it's all there step by step. There's nothing in the law that prevents me from showing someone how somebody with the investment management certificate and who passed level 1 of the Chartered Financial Analysts exam, and worked in the industry for 12 years writing all these reports. There's nothing stopping me showing other people how I do it, and then for people looking at that themselves, and if they need to, getting advice from an independent financial advisor. And MoneyMagpie readers can get a free guide on how to choose a good independent financial advisor if they buy the book. So it's all there, and you can copy it if you want to. And at various points in the book, if you need advice, get advice. Get advice from an independent financial advisor if you feel the need for it. And I go through various points in the book where you can and probably should do that.
And it's a very good reminder that we have to say that nothing that's said in this podcast should be taken as advice. It's one of those legal things you have to say, because if we're just chatting, we end up going, oh, you should do this, but no, yeah. It's up to everybody. We've been talking for quite a while, and I'm realizing I've got my eye on the clock. And you were bold enough to offer to answer some questions from our readers about investments. We put out on social media, on the MoneyMagpie social media and Jasmine Birtles channels, and we've had various questions. So I'm going to pick a few.
Okay.
To see if you could ask them. Firstly, from Rory, he said, I have an ISA on BestInvest and they charge 0.8% fees. Apparently that's the best on the market. He says, is it? I thought I had a good deal, but it looks like even that one is too expensive.
Yeah, I do a review of 24 platforms like BestInvest in my book, and only 4 of them make the grade. The grade being yes, then there's maybe, then there's no, and then there's did not qualify. And my criteria for judging them, number 1 is, do they have a sufficient range of low cost passive funds that allow me very simply to set up my portfolio so I can set it up and then get on with my life. BestInvest, I'm not sure if it's 0.8 or 0.6%, he said in the question. But either way, what I found is that BestInvest was a no for me. It's too expensive. It has too narrow a range of funds, so it didn't make the grade for my low-cost investment portfolios. I would recommend that Rory take a look at other platforms and judge to see if they have a broader range of portfolios that you can choose from. And I go into this in the book. The reason I'm not going to share that here is because I spent 11 months of my life researching all this stuff without a salary. So, the book costs £14. Yeah, get the book. It costs £14.93. And it includes a review of 24 platforms, of which 4 I think are good. And I've taken some of my money out of a maybe and put it into a yes. And I share that, everything and how I did that in the book.
That's good. So from Robert, next question. I have £450,000 in a SIP with Hargreaves Lansdown. It's losing money, and I'd like to move it into a cash savings account like the NS&I one. At the moment, as you know, NS&I is offering 6.2% in their 1-year growth bond, or 5.7% in their 3-year green savings bond. So you can kind of see where he's coming from. He says, can I do that without paying too much tax?
Well, a couple of things here. Again, I can't give advice, but I can make some comments. The average pension pot in the UK according to the Office for National Statistics, for a 55-year-old is £75,500. So firstly, well done, Robert. That's a good bit of money. Now, Hargreaves Lansdown has what I consider to be an opaque and confusing set of fees and charges, and it got a maybe in my review. So I actually lifted some of my money out of my SIP and put it into a different platform, so that I could share that with everyone, and how I did that in the book. Also, Hargreaves Lansdown did not cover itself in glory when they recommended Neil Woodford's fund, which went downhill after he broke his own investment rules, and that really undermined the value of his funds and left him in a lot of hot water, and also pointed a few fingers and raised some questions about Hargreaves Lansdown and how they select the funds that they include on their preferred or starred list. So I have no investments in funds with Hargreaves Lansdown for that very reason. However, in defense of Hargreaves Lansdown, to my understanding, they don't manage the funds. They might have, but my understanding is that they don't. They just sell them. So it's an important point. A lot of people think that all you need to do is find a good company on which to put your money, and then it's done. It doesn't work like that. From my experience in and outside the industry, you have to take control of your investments, which isn't as hard as it sounds, to make sure that you don't get ripped off. And that's the whole point of my book. Now, turning to National Savings and, what was it? What does the I stand for?
National Savings and Investments.
Investments.
Yeah.
Yeah, I don't know enough about SIPs to know if you can transfer into that, but I do know that they don't pay a huge amount of interest. And so you mentioned 6%, was it the higher one?
6.2%, yeah.
6.2. Okay, well, inflation's running at 6.6% at the moment. And there you go. So I would want my money working harder than that. If I needed to keep cash for my cash buffer, which I know you've spoken about in other books you've written and on your website, and that I talk about in my book as well, then I'd consider that for my cash buffer, certainly. But for my investments, for my future, the money isn't working hard enough. I would want it to be working harder than that.
Okay, so next question is from Suzanne G, and she says, I've always had equities ISAs, but now I see that we're back to savings accounts. Savings accounts are doing well. Are there any cash ISAs you could recommend? Also, do they charge fees on cash ISAs?
Oh, Suzanne, there's always a fee. There's always a fee. This is financial people you're dealing with. Yeah, there's a fee. I don't like cash ISAs. Again, I want my money to work harder. I did a quick search around recently to see what cash ISAs were offering. The best I could see was 5% a year. Now, let's assume that they're as good as the NS&I and they're offering 6% a year, but with those fees. And there's also restrictions when it starts to get higher amount as to when you can take the money out. So if you want to take it out quickly, you can't. And as I say, inflation's running at 6.6% at the moment. So that would mean that the best cash ISA that I could find would be losing value because your money would be eroded more quickly than the interest payments are supporting it. So again, my preference would be, yeah, I'd consider it for a cash buffer, but for my investments, I would want my money working harder than that. And a cash ISA just can't do that. I've never invested in a cash ISA for that reason.
Yeah, me too. Jean Smith says, I'm 55 and I'd like to retire before I'm 60, but how much do I need in my pension to be able to do that? I'm guessing more than 75,000 that you've mentioned. And he says, is there anybody I can speak to about it without paying thousands for the advice?
Well, it's a really difficult question to answer. It's one of those things that's a simple question, but a very long answer. So I'll try to keep it short. I reckon you're probably going to have to speak to an independent financial advisor, and please only use an independent financial advisor, not a tied advisor or restricted advisor who works for a bank and can only recommend what they offer. You want one who's independent as far as investments are concerned. But an IFA would have to ask you a bunch of questions like, well, how much money do you have? How much money do you need to live off once you are retired? And in only 5 years to go, that means you're getting close to where you can't take any risk with your money because you need it to be there and not be hit by the ups and downs of market movement. So, you know, it does sound as though you need some professional advice. Now, many IFAs, independent financial advisors, will provide an hour for free on advice as to where you start and what you need to think about in principle. And again, how to select a good advisor is something that MoneyMagpie readers can get if they order the book and mention MoneyMagpie in the delivery notes or anywhere. So yeah, I'm sorry, Jean, but you're going to have to get some advice, because you're in a position where you're in a almost vulnerable, but it's really critical now, with so little time left, that you make the right decisions with someone who really looks at your whole situation and gives you professional advice.
S. Wright said, can I just buy the shares direct? Why do I have to use one of these platforms or broker websites at all? Why can't I just put money into those funds directly like I would with a savings account? Which is a good question, really.
Yeah, and I know what S. Wright means, but it's actually not that bad these days. Buying shares is pretty straightforward, and it's relatively cheap. And the UK is one of the best countries in which to do that, because we have no real pension to speak of. So the government has had to make it better for us. Also, because the UK has a tradition of having its pension in the form of bricks and mortar, and that's getting harder and harder now. So again, that's another incentive why it's been made relatively easy to buy actual shares. But now the government is threatening to ruin ISAs. I really hope they don't, but they're saying they have to simplify it. They don't. It's already simple, but there we go. So buying shares is pretty straightforward. There has to be a marketplace in which to buy those shares, which are also referred to equity or stocks. And the marketplace requires broker websites that take care of all the things that you don't think about when you're buying a share, such as having the money you put up guaranteed in what's called a third-party custodian. They hold the money, and somebody else holds the certificate electronically, that all used to be done on paper but now is done electronically, that you don't even think about. So it has to go through a broker that is approved and managed by the Financial Conduct Authority. There's a whole bunch of stuff that you don't think about that people called Malcolm are doing somewhere in Newport Pagnell. And good luck to them. So mine isn't like that, because I've done that. And this is what I was talking about with the money I was spending to select shares and invest in them. And I've got a whole library of books and a whole load of tools that allow me to do that. But it's hard work. But if that's what you really want to do, there is a book I would recommend by a really terrific bloke who I have met more than once. His name is Robbie Burns. He wrote The Naked Trader. And if you want to buy and sell shares, specific companies, and are prepared to do the homework and to manage your shares and to keep an eye on stuff and really do your own work and kind of have a hobby of it, where you put the time and effort in and have the costs of buying information that you need, then The Naked Trader is the book for you.
Good. I agree. As you know, David, I'm always saying the same, that if you want to do that, you could potentially make a lot of money, but it's a lot of work, actually really studying and daily watching the markets, watching it. Yeah, it's a tough one.
It is. And mine isn't like that. Mine's much, much simpler, because I was doing that. I'm tired of it. I want it to be nice and easy now. So I've spent 11 months building the framework. I share it in the book. So now all I have to do is once a quarter, I'll update the allocations, I'll update the preferred funds, and it's all done. Yeah,
that's brilliant. Do you know, we did have other questions, but we're coming to the end. We've been talking for far too long.
Have we?
But we've got lots of information. Really, you've given us so much good information there. And obviously the majority is in your book. And there's also, but let's talk again about the free book that you're offering. What do people get in that, and how can they get it?
Sure. Well, the free book has a really long title. It's 14 Steps to a Low Cost, Low Maintenance Investment Portfolio. It's about 60, 70 pages long. I can't remember how long it is, but it gives you the principles of everything I've done. So if you want to do it yourself and not buy the book, this will give you the principles of what you need to do. Now, bear in mind, I'm an industrial, experienced investment financial bloke, and it took me 11 months to set it up. So if you're into it and it will be fun, and for some people it will, then fill your boots. But yeah, if you want the full book, then that's elsewhere. But the free ebook, that will be, I believe, on the MoneyMagpie book library. And I'm more than happy for you to share it on the website, in the for anyone. Better still, yeah, if you've signed up for the MoneyMagpie newsletter, then you can have a copy, because I think they really should be signed up to your newsletter, because it covers so much more than just investments. So that's probably the best way to get it.
That would be good. And the book itself, how much is it? And what's in there that isn't in the free ebook?
Okay, well, it's kind of sitting next to me and watching me do it step by step with all the screenshots. Now you move the mouse here, you press this button, you type this number in, you hit this. If it does that, then you just go back here and do that. If it does this, you're great, you're sorted. And it's £14.93. You can get it on Amazon. And if you mention MoneyMagpie in the delivery instructions, then I tell you what I'll do. I will go through all the questions you've given me. I will include a transcript of all the answers, and I'll include the how to choose a good IFA, only both of those for MoneyMagpie readers. And in that, you'll see how to set up step by step a low cost, low maintenance investment portfolio that you spend a few hours up front once setting up. And I show you exactly how I do that. It might not be right for you. Get financial advice just in case. But I go through exactly how I do that. And then once a year, I go through how I spend 1, maybe 2 hours once a year, making sure it's on track. It's all there. The platform reviews, the funds you need, the lot.
That's fantastic. So basically, you show people how to set up a fund that, you know, a set of funds that works for them, and it
works for me.
Yeah, it works for you, and potentially
because I can't give advice.
No, exactly. And then it's just 2 or 3 hours a year to maintain.
Well, to be honest with you, I've done it once. I've tested a few times with different levels of portfolio. So you can start from a very small amount of money where there really isn't much to manage, and you may be spending 10 minutes once a year until it starts to build up, to a much bigger portfolio. Because I have a couple of millionaire friends, I try to keep them close.
Yeah.
And they're shifting some money over to see how it works for them, and just to test it, because one in particular, he is being royally ripped off. Anyway, so yeah, for him it will take an hour a year, maybe 2 hours a year, just to make sure it's on track. But that's the point, you know. He just sold his business. He had to have heart surgery because he'd worked so hard and he was so stressed that, you know, he was really close to dying. So life's too short to be messing around with investments. So set it up, get on with your life, and then spend an hour or two once a year making sure it's on track.
Fantastic. David, I'm going to get you back on another podcast later on. We'll see if we can, you know, get some more questions, have a look at the portfolios, maybe get people in who've been using the book as well, so that we can
do that. Yeah, because if I get their feedback and they say, well, I didn't understand this, well, I'm in a position to correct it. And if they've got a copy of the book, then providing they're your newsletter subscribers, I will send them an updated version of the book through you.
Lovely.
So that, you know, we can work together to make it really, really good for your users.
Excellent. Well, thank you, David. Thank you. This has been David Ryder, author of How to Invest Without Being Ripped Off, Set Up Your Investments, Save Money, Get On With Your Life, which is $14.99. You can buy it on Amazon.
$14.93.
Oh, for it, $14.93. I'm so sorry. That's important, as we know.
Yeah, you can invest that 6 pence.
Gosh, you could, absolutely. You can also get it through moneymagpie.com, of course, my website. As David mentioned, we have a number of newsletters on MoneyMagpie. We have a basic one, our one that goes out every Tuesday, which covers all sorts. And we also now have an investing newsletter, which goes out every other Saturday. So sign up to both of those on moneymagpie.com. They're both free. And thank you for joining us on this MoneyMagpie podcast. Don't forget to share and like and of course subscribe, because we've got many more of these coming up. Generally, of course, gush about us to your friends. You know you want to. Today's podcast was presented by me, Jasmine Birtles, and you can find out lots more podcasts and websites on MoneyMagpie.com. Take a look.